Welcome to Sales, Tax, and More, your go-to resource for all things state tax related. Now, here is your host, Michael Fleming.
Hi, I'm Mike Fleming, founder of Sales, Tax, and More, and today's host of the Sales, Tax, and More podcast, where we talk about everybody's favorite subject, sales tax. And today I have Jeremy Weiss on the line with us here, and he's done thousands of interviews with successful entrepreneurs and CEOs, and today we're flipping the script, and we're going to have him interview me.
Awesome. Michael, thank you so much for having me. And just a brief introduction for Michael, if you don't know him and his company. I consider, and many other people consider him, one of the USA's leading authorities when it comes to sales tax. And the episode is brought to you by Sales Tax and More, and they assist companies and their trusted advisors with their sales tax needs. They offer consulting and research, registrations, returns, and much, much more. And over the years, they've assisted thousands and thousands of sellers, both foreign and domestic, with their tax issues in the United States and Canada. You can go to salestaxandmore.com for more information. They have so much experience in this realm. And I'm excited to talk, Michael, about a few things. And you get some commonly asked questions over and over again. So I want to bring those up. And we kind of polled people and what their biggest questions were so you can answer them. And even before they pay you money, you know. So we're going to tap in and pick your brain about some of the frequently asked questions. One of the top one that I know you get is, when does a company need to worry about collecting sales tax?
Absolutely.
So hopefully you can address that.
Oh, yeah. And this is probably the number one question that we get. And, you know, it's really four factors that you want to be taking a look at. And the first factor is, you know, whenever you have a link or a connection with a state, and you may have heard the word nexus, that's what we call this link or connection. So whenever you have a link or a connection with a state, then the state can require you to potentially collect its sales tax. Now, it's not automatic. There's a couple of other steps we want to look at. But if you don't have this link or connection, then you're great, because the state can't require you to collect a tax like a sales tax or pay a tax like an income tax. There's just no responsibility there if you don't have this connection we call nexus. So once you determine if you have nexus, and by the way, there are lots of types of nexus, but you know, we break them down into two main types. You've got a physical nexus, which can be misleading, and we'll talk about that in a little bit here. And you have an economic nexus. This is a new concept for sales tax, and it was a result of the Wayfair versus South Dakota. And that just means if you have a certain amount of sales into a state, you could create nexus. You don't have to have physical presence there. Yeah, absolutely. That's huge. It's what this Wayfair case did is overturned 51 years of precedent. The Supreme Court came out and said, we never should have introduced the concept of physical presence to nexus. It's just not something that is required to create this link or connection. So lots and lots of items can be physical presence. For example, independent contractors. You know, we talked about in our case studies how independent contractors can actually create nexus for a company if they're helping to establish or maintain a marketplace. So,
go to a different episode where you actually walk through a specific example of someone who didn't know this and what happened. They had an independent contractor in a different state. So you could check that episode out. But so that'd be an example of a physical nexus. Any other examples?
Where you live or operate your business from. A lot of people nowadays tell me, well, Mike, you know, I do everything in the cloud. I have a virtual office. I'm not physically located anywhere.
I'm literally in the cloud.
Yeah, I'm in the cloud. How you defy the laws of physics there, I'm not sure. But wherever you live or operate your business from, you know, that creates some sort of link or connection with the state, and the state's going to say that is enough to create nexus. Subcontractors, traveling salespeople, people doing installations, implementations, trainings, going to trade shows. I mean, there are just tons of different activities out there.
Complicated.
Yeah, it gets pretty complicated. And the tough part is some things across the board are going to be creating nexus. You have salespeople in a state, then that's going to create nexus across the board. You have independent contractors in a state or traveling into a state to do sales. That's going to create nexus across the board. But some things are very different from state to state. So
if that salesperson's, let's say, whatever, independent contractor or employed, and let's say they're in Wisconsin, but they have to travel to do business in Iowa and Midwest, would you have nexus in those states where they travel into and you do?
Unfortunately, some states have a de minimis. How often do they do it? How frequently they do it? But some of these states like Michigan and Arizona say that if you've got people coming into the state for greater than 48 hours cumulative throughout the year, then that's going to be nexus creating.
Yeah.
So,
and what about trade shows?
Thresholds.
Trade shows. Like, I mean, if you go to Vegas, let's say you go to Vegas every year for a week, and your people are making sales at that trade show. How does
Well, Vegas is a little bit different because there's so much of their economy is based upon conferences and trade shows and conventions. So most states, do one of four things. They say if you just attend as a consumer, it can create nexus. Other states say, hey, you can come as often as you like as a consumer, but once you start exhibiting, then that creates nexus. Other states,
it does.
Oh yeah, absolutely. Just exhibiting in a lot of states. There are other states that say, well, you can exhibit, you just can't solicit. Now, how you draw?
You're like, why would you exhibit without soliciting? Like, forget it. I'm not even going to exhibit.
Exactly. So, and then the fourth group say that you can even solicit so long as you don't accept orders. So those are usually the four ways that states look at this. Vegas is entirely different. Vegas says you can do all of those things as often as you want. You can even, deliver products while you're here. You can collect products while you're here. And that does not create nexus so long as you collect the tax on what you're selling. And at the end of the show, you give it to the promoter and say, hey, Mr. Promoter, you can turn this in for me. Or if he doesn't want to do it or she doesn't want to do it, when you get home, then you just mail it into the state. You can do that once a year. If you're doing it twice a year, it's nexus creating. But if you do it up to once a year, then it's not nexus creating. You still got to collect the tax, but not nexus creating.
Yeah, but other states may work differently, obviously. Someone goes to a conference every year in California or something, right? So I mean, everything in Vegas stays in Vegas. So everything goes there. But that's its own animal, I guess. Right?
And some states have very good, what we call de minimis exemptions. Like California, theirs is if you're there for less than 2 weeks and less than $100,000 in revenue results from the show, then that's not nexus created.
Yeah. I mean, like Dreamforce is going on right now, right? Dreamforce is, I don't know, week, 2 weeks, there's hundreds of thousands of people that come through there, and a lot of them go there every year for extended period and probably make a lot of software sales.
Yeah. So that could be nexus creating.
Yeah. So physical, and I don't know if there's anything else on physical, and then I'll let you talk about the economic.
Yeah. I mean, pretty much just remember that your employees, you, and third parties, subcontractors, independent contractors, if they're traveling into a state, you got to be asking the question or asking someone like us, can this potentially create a link or connection with that state where the state could then, require me to collect or remit the taxes. On an economic basis, again, states don't ever make anything easy on you. It's not like there's one rule for all.
They want their money.
They want their money. And, the lowest thresholds out there are the states that say, like South Dakota, this is the case involved in the Wayfair case, $100,000, which is a fairly high number, or 200 transactions. And it's that or 200 transactions that really trip people up. That
could be killer.
Yeah.
Let's say you sell stickers or something, right? It's like you can easily sell 200 package of stickers that is equivalent to $1,000 and you have Nexus.
Absolutely. We're going to talk about that. That's our third point.
Got
so
it.
Before you go out and get registered, just because a state says you have to do something doesn't mean it makes good business sense. And sometimes you're going to want to ignore what the state says if your exposure is not material. We got to use common sense when we apply that. So, the states don't tell you to, use common sense. They just want you to do it from dollar number one most of the times. But in your specific example there, I would not get registered. I would counsel my clients to wait until the state come and finds them. You'll spend more money trying to do what the state says to do, getting registered.
I've done that, Michael, and you've helped me. I speak from experience. Yes, you know what you're doing. And yes, I did it wrong before. So yes, you'll spend a lot more.
Yeah. And there's always you got to take the cost of compliance into account. But let's go back to taxability. Okay. Because taxability is the second thing. So let's assume you do have this linker connection called Nexus. Because if you don't have it, we're not talking about taxability. It stops with Nexus. I mean, if you don't have Nexus, you don't have any problems. No, don't go any further. Do not pass go. But if you do have Nexus, now we got to look at, is what you're selling taxable in that state? And, if you're selling widgets, they're going to be taxable pretty much in every state, in the country. But there are certain products out there like dietary supplements and clothing. And, in some states, not a lot of services are taxable. I mean, so it all depends on what you're selling. So the second thing we need to do is determine if what you're selling is taxable. And if it is taxable, then we go on to the third step. If it's not taxable, well, we stop right there. No need to go further. So the third step we started touching on, which is materiality. And, so if you have this linker connection we call Nexus, if it's taxable, then we got to look at if your exposure is material. So in your card collection example there, $1,000, I just, can't justify telling someone to go
just
out
to
and
register is going to cost you more.
Absolutely. So, I can't, people always say, well, Mike, what is material? And I can't tell you what is material for you because for each company, it's generally going to be a little bit different. I mean, for those of you who have hear me speak before, I talk a lot about Coca-Cola. And $100,000 to Coca-Cola is a rounding error, where $100,000 to me is a heck of a lot of money.
Right.
So just every company out there, what's material to them is going to be a little bit different. I generally tell them to look at three things. I mean, Jeremy, we have people calling us, close to tears. They're so worried about this, and if that's you, then you want to have a much lower threshold than someone who comes in. We'll use Vegas here. I go to Vegas every weekend. I never lose. Nothing bad has ever happened to me in my life, and I don't think the states are going to find me. So
what one mentality
tolerance is.
Right.
I mean, they're polar opposites. Someone with the first one is going to have lower thresholds, personal thresholds. This has nothing to do with the state. This is them saying, I'm going to get registered when my sales hit this level. And on the upper end, you've got people saying, I'm going to stretch a little bit further. And our clients are usually somewhere between $3,000 on the low end and $20,000 on the high end. If you want to drop down, 98% fall within that. 80% are going to fall between the $5,000 and $10,000 range. Now, second thing you want to look at in materiality is, what are your profit margins? I mean, you wouldn't believe how many people I talk to are trying to build market share, and they're not making any money, or they're 2% profit margins. I sometimes scratch my head and say you work so hard to try to do this. I mean, it might be cheaper to go down to McDonald's, or better off going down to McDonald's and get a job there, because there's so much work to not make money.
Right. At the end of the day, you're not left with much.
Exactly. So if you're on that lower end of the range, if you're building market share, if you've got really low margins, remember this: average sales tax rate is 8%. And if we add another 50% on top of that for penalty and interest, you're looking effectively at about a 12% exposure rate. So for every $1,000 you spend, it's $120 in potential exposure. And, so as your sales go up, so does that $120. And you don't want to look at it as if the state found you this afternoon, but what happens if they find you 3-4 years down the road? So, the margins, if you've got a 2% margin and 12% penalty, not only can you wipe out all the profits in one state, but you probably have put yourself out of business if a state finds you 2, 3, 4 years down the road. So the lower your profit margin, then you want to have a lower threshold. The higher your profit margin, then you can, get a little bit of breathing room in there and decide if you want a little bit of a higher personal threshold. And then the third thing are capital reserves. I mean, I've seen some really big companies, and, this time of year, and the state of Washington found this one company, and, they had to pay like $500,000. I mean, that's a big chunk of change. And the company told me, Mike, we can't pay it. We need some sort of payment plan, because all of our money is tied up in inventory. And this is a $20 million company, so they were a good-sized company. 2 points there. If you don't take care of it, it can cost you a lot of money. This company was not happy paying that. But getting back to reserves, if you don't have cash reserves, if a state does find you and it's going to impact your business materially, then you want to have a lower threshold. You don't want a state to be able to shut you down or impact how you're doing business because you had a threshold that was too high, personal threshold.
Yeah, I was talking to someone the other week that they may have to shut down because it's not worth it for them to stay in business, and what the state says they owe, so it's unfortunate. It does happen.
Yeah, and you want to know what's even worse? Shutting down is not always going to save you, because in a lot of states, there's personal responsibility. So even if you go and shut down, even, in California, you generally have to have collected the tax and not remitted it for the personal responsibility to really.
Right.
But in a lot of states, that's not the case, and they will pursue you. And even if you bankrupt the company, they'll come after you personally. Even if you bankrupt yourself, states can be 10 times worse than the IRS was at their worst. 20 years ago, the horror stories you hear. So you got to be careful. That's why it's better to be proactive and take care of this stuff up front, so you don't find yourself in one of those positions and having the state chasing you to the grave.
Yeah. So just a quick recap: when a company needs to worry about collecting sales tax, they need to think about the nexus, the taxability, the material piece. Anything else that we should mention?
Yeah, the absolute last one. Nowadays, we see a lot of people selling on marketplaces like Amazon and eBay, in addition to their other channels, or maybe just selling on those platforms. A lot of people are very successful. And if you're only selling on a marketplace, there are 40 states at this point who have said the marketplaces are responsible for collecting and remitting that tax on your behalf or on your client's behalf. So you got to make sure you're the one responsible for collecting the tax. We get a lot of calls right now and saying, hey, I see that Amazon is now going to be collecting in the state of California. Do I need to get registered in California? And actually, the exact opposite is true. Now is the time that you want to start looking at, if you're already registered, looking at which states you can deregister in. Because in general, once Amazon starts collecting, or one of these other marketplaces, if you're only selling on marketplaces, you don't have any taxable sales anymore. Someone else is responsible for collecting that tax. So that wraps up the top 4 reasons. We've got Nexus, which is just a link or connection with the state. We've got is what you sell taxable, and services. By the way, a lot of people think that services are not taxable. They are taxable in a lot of states. Materiality, which I also call common sense, is the amount actually material? And are you the one who's actually responsible for remitting the tax, or is it a third party like a marketplace?
Cool. Mike, thank you. If you have questions, go to salestaxandmore.com and check out more episodes where, again, everyone's favorite topic, sales tax. Thanks, Mike.
Thanks, Jeremy.
Thanks for listening. Be sure to click subscribe and check out all of the resources we have out on the web.